Dividends are one of the most reliable ways to generate passive income in the world of investing. Whether you're new to investing or looking to expand your portfolio, understanding how to make money with dividends is essential. This guide will walk you through the basics of dividend investing, helping you understand what dividends are, how they work, and how you can start earning a steady income from them. What are dividends? Dividends are payments made by a corporation to its shareholders, typically in the form of cash or additional shares of stock. When you own a share of a dividend-paying company, you essentially own a small piece of that company. As the company earns profits, it may choose to distribute a portion of those profits to shareholders in the form of dividends. Types of dividends. There are several types of dividends, including cash dividends, stock dividends, and special dividends. Cash dividends are the most common and are usually paid on a quarterly basis. Stock dividends involve issuing additional shares to shareholders, while special dividends are one-time payments made during exceptionally profitable periods. Dividend yield. This is a key metric for evaluating dividend-paying stocks. It's calculated by dividing the annual dividend payment by the stock's current price. For example, if a company pays $2 in dividends per year and the stock is priced at $50, the dividend yield is 4%. A higher dividend yield indicates a more substantial income relative to the stock price, but it's important to assess whether the dividend is sustainable. How to start investing in dividends. Research and select dividend-paying stocks. Start by researching companies that have a history of paying consistent dividends. Look for companies with strong financials, stable earnings, and a solid track record of dividend payments. Many established companies, such as those in the utility, consumer goods, and healthcare sectors, are known for paying reliable dividends. Dividend reinvestment plans, DRIPs. Consider enrolling in a dividend reinvestment plan, DRIP. DRIPs allow you to automatically reinvest your dividends to purchase more shares of the stock, rather than receiving the cash. This can accelerate the growth of your investment by compounding your returns over time. Diversify your dividend portfolio. Just like any investment strategy, diversification is key. Spread your investments across different sectors and companies to reduce risk. This ensures that if one company cuts its dividend, your overall income isn't significantly impacted. Understand dividend payout ratios. The dividend payout ratio is the percentage of a company's earnings that are paid out as dividends. A payout ratio above 100% indicates that a company is paying out more in dividends than it earns, which is typically unsustainable. Look for companies with payout ratios that indicate a balance between rewarding shareholders and retaining earnings for growth. Maximizing dividend income. Focus on dividend growth stocks. Dividend growth stocks are companies that not only pay dividends but also regularly increase their dividend payments. These stocks can be particularly valuable for long-term investors, as increasing dividends can lead to significant income growth over time. Consider high-yield dividend stocks. High-yield dividend stocks offer higher than average dividend yields. However, it's important to approach these stocks with caution, as very high yields can sometimes be a sign of underlying financial trouble. Carefully evaluate the company's financial health and dividend sustainability before investing. Tax considerations. Understand the tax implications of dividend income. In many countries, qualified dividends are taxed at a lower rate than ordinary income, making them an attractive source of income. Be sure to consult with a tax advisor to understand how dividend income will affect your tax situation. How to choose the right dividend stocks. Choosing the right dividend stocks is crucial to building a portfolio that generates consistent income. While many companies pay dividends, not all dividend-paying stocks are created equal. To maximize your returns and minimize risks, it's important to follow a systematic approach when selecting dividend stocks. Evaluating dividend history. Consistency of dividend payments. One of the first things to look for is a company's history of paying dividends consistently. Companies that have a long track record of paying dividends, particularly those that have increased their payouts over time, are often more reliable. These companies are commonly referred to as dividend aristocrats if they have increased dividends annually for at least 25 consecutive years. Dividend growth rate. Beyond just paying dividends, focus on companies that have a history of increasing their dividend payouts. A growing dividend is a sign of a healthy, profitable company. Look at the dividend growth rate over the past 5 to 10 years to assess the company's commitment to returning value to shareholders. Financial health and stability. Revenue and earnings growth. Before investing in a dividend stock, examine the company's revenue and earnings growth. Companies that consistently grow their revenues and earnings are more likely to sustain or increase their dividend payments. Be wary of companies with stagnant or declining revenues, as this could indicate potential difficulties in maintaining dividend payouts. Strong balance sheet. A strong balance sheet is another key indicator of a company's ability to pay dividends. Look for companies with low levels of debt, ample cash reserves, and strong cash flow. These financial metrics suggest that the company has the financial flexibility to continue paying dividends even during economic downturns. Payout ratio and sustainability. Dividend payout ratio. The payout ratio is a critical metric that indicates how much of a company's earnings are being paid out as dividends. A lower payout ratio generally means that the company is retaining more earnings to reinvest in the business, which can be a good sign of sustainability. A payout ratio of 60% or lower is typically considered safe, while a higher ratio could indicate that the dividend may not be sustainable. Free cash flow. Evaluate the company's free cash flow, which is the cash remaining after capital expenditures. Free cash flow is important because it shows whether the company can cover its dividend payments from its cash-generating operations. Positive and stable free cash flow is a strong indicator of a company's ability to maintain its dividend. Industry and sector considerations. Industry stability. Some industries are more stable and recession-resistant than others, making them better suited for dividend investing. For example, utilities, consumer staples, and healthcare are sectors known for their stability and consistent demand, which often translates into reliable dividend payments. Economic sensitivity. Consider how sensitive a company's earnings are to economic cycles. Companies in cyclical industries like consumer discretionary and industrials might have less stable dividend payments because their revenues can fluctuate with economic conditions. In contrast, companies in defensive industries tend to offer more consistent dividends. Valuation metrics. Price to earnings, P/E ratio. The P/E ratio helps you assess whether a dividend stock is overvalued or undervalued. A lower P/E ratio might indicate that the stock is undervalued, presenting a potential buying opportunity. However, be cautious of extremely low P/E ratios, as they could signal underlying issues with the company. Dividend yield versus competitors. Compare the dividend yield of the stock you're considering with those of its industry peers. A yield significantly higher than the industry average could be a red flag, suggesting that the market is pricing in potential risks. On the other hand, a yield that is too low may not provide the income you're seeking. Management and corporate governance. Management's track record. Investigate the management team's track record in creating shareholder value. Have they made smart capital allocation decisions, such as reinvesting in profitable projects or returning capital to shareholders through dividends and share buybacks? A capable management team is crucial for the long-term success of the company and the sustainability of its dividends. Corporate governance practices. Good corporate governance ensures that the company is run in the best interests of shareholders. Look for companies with a transparent and accountable board of directors, as well as shareholder-friendly policies. Poor governance can lead to mismanagement and decisions that harm shareholder value, including dividend cuts. Building a diversified dividend portfolio. Creating a diversified dividend portfolio is crucial for managing risk and ensuring a stable income stream. Diversification spreads your investments across various sectors and companies, reducing the impact of any single stock's poor performance on your overall portfolio. Why diversification matters. Risk mitigation. Investing in a variety of dividend-paying stocks across different industries helps protect your portfolio from sector-specific risks. For example, if you only invest in dividend stocks from the energy sector and that sector experiences a downturn, your entire portfolio could suffer. By diversifying, you reduce the likelihood that a single event or economic shift will significantly impact your income. Income stability. Different sectors perform well under different economic conditions. For instance, utility companies tend to be more stable during economic downturns, while consumer discretionary stocks might perform better during periods of economic growth. A diversified portfolio allows you to benefit from various market conditions, ensuring a more consistent income stream. How to diversify your dividend portfolio. Sector diversification. Aim to invest in dividend-paying stocks from a range of sectors, such as healthcare, utilities, consumer staples, technology, and financials. Each sector reacts differently to economic changes, so spreading your investments can provide balance and stability. Healthcare and utilities. These sectors are known for their stability and consistent demand, making them excellent choices for core holdings in a dividend portfolio. Companies in these sectors often provide reliable dividends due to their steady cash flows. Technology and consumer discretionary. While these sectors can be more volatile, they also offer opportunities for growth and higher dividend payments over time. Including these sectors can add growth potential to your portfolio, but they should be balanced with more stable sectors. Geographic diversification. Consider including international dividend-paying stocks in your portfolio. Different regions of the world experience economic cycles at different times, so investing globally can further reduce your risk. Developed markets. Look for dividend-paying companies in developed markets like Europe, Japan, and Canada. These markets often provide stability and reliable dividends, similar to the US emerging markets, while riskier, emerging markets can offer higher dividend yields and growth potential. However, these should make up a smaller portion of your portfolio due to the higher risk. Dividend growth versus high yield. Balance your portfolio between dividend growth stocks and high yield stocks. Dividend growth stocks. These stocks may have lower initial yields, but offer the potential for increasing dividends over time. They are often found in sectors like technology and consumer goods, where companies reinvest earnings into growth opportunities. High yield stocks. These stocks provide higher immediate income, but may have less potential for capital appreciation. Common in sectors like utilities, rights, real estate investment trusts, and telecommunications, they are ideal for investors seeking steady cash flow. Consider dividend ETFs. If you prefer a hands-off approach, dividend-focused exchange-traded funds, ETFs, can be a great way to achieve diversification. These ETFs invest in a basket of dividend-paying stocks, spreading your risk across multiple companies and sectors with a single investment. ETFs for stability. Look for ETFs that focus on stable, blue-chip dividend stocks, which are less likely to cut dividends during economic downturns. ETFs for growth. Consider ETFs that focus on dividend growth, which invest in companies with a history of increasing dividends. These can provide a growing income stream over time. Rebalancing your portfolio. Regular portfolio review. It's important to regularly review and rebalance your portfolio to ensure it remains aligned with your investment goals. Over time, some stocks may perform better than others, leading to imbalances in your portfolio. Rebalancing involves selling some of the better performing stocks and reinvesting in underweighted areas to maintain your desired asset allocation. Reinvesting dividends. Consider reinvesting the dividends you receive back into your portfolio. This can be done automatically through DRIPs or manually by purchasing additional shares of other dividend-paying stocks. Reinvesting dividends accelerates the growth of your portfolio and increases your future income potential. Monitoring for dividend cuts. Stay vigilant for any signs that a company might cut its dividend, such as declining earnings, increasing debt, or a very high payout ratio. If a company cuts its dividend, it may be wise to reevaluate your position in that stock and consider reallocating those funds elsewhere. Reinvesting dividends. The power of compounding. Reinvesting dividends is one of the most powerful strategies available to dividend investors. By automatically reinvesting the dividends you receive back into the same stock, you can harness the power of compounding, leading to exponential growth in your investment over time. Understanding dividend reinvestment plans. DRIPs. What is a DRIP? A dividend reinvestment plan, DRIP, allows investors to reinvest their cash dividends into additional shares of the company's stock, often without paying any commission fees. Many companies and brokerage firms offer DRIPs, making it easy to automate this process. Benefits of DRIPs. The primary advantage of using a DRIP is that it allows you to purchase additional shares with the dividends you receive, which in turn will earn dividends themselves. This creates a snowball effect, where your investment grows faster as time goes on. No commission fees. Many DRIPs allow you to reinvest dividends without paying the usual commission fees, making it a cost-effective way to increase your holdings. Fractional shares. With DRIPs, you can buy fractional shares, meaning every dollar of your dividend income is reinvested, maximizing your return on investment. The power of compounding. Compounding explained. Compounding occurs when the earnings on your investments generate additional earnings over time. When you reinvest dividends, you increase the amount of shares you own, which in turn generates more dividends, leading to a compounding effect. Over long periods, this can significantly boost the value of your portfolio. Example of compounding. Imagine you own 100 shares of a stock priced at $50 each, paying a 4% annual dividend yield. If you reinvest the dividends, over the years, the number of shares you own will grow, and so will the dividends you receive, leading to a larger portfolio. Time is your ally. The longer you reinvest your dividends, the more powerful the compounding effect becomes. Even modest dividend yields can result in substantial wealth accumulation if dividends are reinvested over several decades. Reinvestment strategies. Automatic reinvestment. Many brokerage accounts allow you to automatically reinvest dividends into the stocks or funds that paid them. This hands-off approach ensures that your dividends are consistently reinvested, helping you stay disciplined in your investment strategy. Set it and forget it. Once you set up automatic reinvestment, there's no need to manually reinvest dividends each time they're paid. This automation can lead to a more consistent investment approach and less emotional decision-making. Selective reinvestment. Instead of reinvesting dividends back into the same stock, some investors prefer to take a more hands-on approach by selectively reinvesting dividends into different stocks or funds. This strategy allows for greater flexibility and the opportunity to adjust your portfolio based on market conditions. Target undervalued stocks. If a stock in your portfolio becomes overvalued, you might choose to reinvest dividends into a different stock that offers better value. This approach can help you manage risk and potentially increase your overall returns. The impact of reinvesting in high dividend growth stocks. High dividend growth stocks. Reinvesting in stocks that not only pay dividends but also regularly increase their dividends can supercharge the compounding effect. As the dividends grow, and you continuously reinvest them, your portfolio's growth rate can accelerate dramatically. Long-term wealth creation. High dividend growth stocks can be particularly powerful for long-term investors. These stocks often represent companies with strong financial health and growing profits, which can provide both income and capital appreciation. Considerations for reinvesting dividends. Tax implications. It's important to be aware of the tax implications of reinvesting dividends. In taxable accounts, dividends are usually subject to income tax, even if they are reinvested. However, in tax-advantaged accounts like IRAs or 401ks, dividends can be reinvested without immediate tax consequences, making these accounts ideal for maximizing the benefits of dividend reinvestment. Diversification. While reinvesting dividends is a powerful strategy, it's also important to maintain diversification. If a single stock becomes an outsized portion of your portfolio due to reinvested dividends, you might consider reinvesting future dividends in other assets to maintain a balanced portfolio. Make sure to subscribe to the channel and hit the like button to stay updated on more tips and strategies to grow your wealth.